Do you want to better understand why financial market prices go up and down so you can make profitable trades and investments? Well, in today's episode, we're going to talk about the real driving forces behind market prices, and I'm also going to bust some common myths that cause people to make expensive mistakes. Welcome back to Chris Dunn TV, the show that's all about helping you develop valuable skills to create more income and build more wealth in today's economy. And if you're new here, don't forget to hit that subscribe button so you don't miss any future episodes. So if you want to make profitable trades and investments, you really need to understand why prices go up and down so you know when to buy and sell. And I see a lot of misconceptions in the media, online, and just in general conversations between new and experienced traders and investors talking about the reasons why they think prices go up and down. So we're going to just dive right in and talk about the real reasons that prices move. So to better understand why prices move, we first have to define what markets are. And we'll start by just looking at a couple of different market segments. The first is financial markets, right? Like the stock market, cryptocurrencies, right? And under those, you have different markets. Like under the stock market, you have different derivatives like futures and options and, ETFs and just so many different ways to participate in the stock market. Also with cryptocurrencies, you can buy the spot market, you can trade futures, you can buy ETFs, right? And also there's consumer markets, right? Like a car, there's a market for cars where you have a buyer and a seller. You have food, you have entertainment, real estate, you have residential, you have commercial, right? Commodities, you have markets for oil and gold. And sometimes financial markets trade in an organized location like a trading pit or online. Sometimes it's a private transaction between one buyer and one seller. And so there's really two types of markets. The first market is a marketplace, right? This is like Amazon or malls or Best Buy. This is where you go to just buy and sell goods and services, like maybe even a flea market. And oftentimes the price is set by the seller. Maybe it's a retailer, maybe it's an individual, and sometimes there's room for negotiation, but for the most part, prices are fixed, and the buyer either takes the offer or not. They leave and go look for another deal. And the second type of market, which is really what we're going to focus on today, are auction markets, right? This is like the stock market. This is online cryptocurrency exchanges, right? These are financial markets where it's an auction where you have a bunch of buyers and sellers trying to sell to one another, buy from one another, right? And it's a lot more complex than just your typical marketplace where you go to buy something from a retailer. And basically, when a buyer and a seller agree on a price, a transaction takes place. If I want to buy Apple stock at $10 and the next person that's willing to sell is at $100, there's not going to be a transaction there because buyer and seller don't agree on price. And trading in its pure essence is a competition, right? People are competing against each other to profit. So who are these people? Who are these market participants? There's really two or three main categories. The first is institutions, right? This is like banks, you have hedge funds, mutual funds, pensions, right? Basically companies that are set up with different goals, right? Some of these companies manage other people's capital, maybe their retirement accounts. Some of them are banks where they're trying to profit on your bank deposits. The other is independent traders and investors like maybe you and me, where we are managing and trading and investing our own capital to grow our personal wealth. Right. And then the third category, which this kind of can go under both institutions and independent people, but algorithms, basically computers. These are separate market participants. These are computers or software programs that execute trades without human interaction. So it's the cumulative actions of all of those market participants that causes prices to go up and down. And let's just talk about Economics 101, supply and demand. This is at its most fundamental core what moves price. And when you have an imbalance in supply and demand, that's what causes price to either go up or go down. And when prices reach equilibrium, that's what creates stability. So when you have more demand than supply, it pushes prices up. When you have more supply than demand, it pushes prices down. And when they're basically even, when you have buyers and sellers that agree that, okay, this is kind of a fair price, that's where you find equilibrium and price just kind of stagnates, right? And as a trader or an investor, your goal is to find imbalances in supply and demand where you anticipate that that's going to shift in the future. And probably the best way to explain this phenomenon of supply and demand and how it actually applies in the real markets is the greater fool theory, right? People, whenever they buy a market, it could be Bitcoin, it could be Apple stock, whatever you're looking at, people buy that market because they believe somebody else is going to buy at a higher price in the future, right? This is what value investing in the stock market is all about. This is what Warren Buffett does. He looks for companies that he thinks are cheaper and that in the future is going to be worth more, right? Same thing with cryptocurrencies, with Forex, with any financial market on the planet. This is what drives buying behavior. People don't buy because they think the price is going to go down over time. They think they're buying because they think that they're getting a deal. But on every transaction, there's a buyer and a seller. So it's an exchange of opinions. So for every person that thinks they're buying at a good deal, there's a seller that thinks that they're selling at a good price. And that leads us to myth number one. And I've heard this said a lot where price went up because there's more buyers than sellers. But the reality is that the number of buyers and the number of sellers is completely irrelevant. The only thing that matters and what it all boils down to is trading volume. So for example, you could have one buyer and 10 sellers, and that one buyer, maybe it's a bank, maybe it's just a large whale trader or investor, they could buy all the supply from 5, 10, or dozens of sellers, right? Say there's a lot of people trying to get out of a market. They think that it's expensive and it's a good price and everybody's in profit, but you have this one buyer that steps in and says, I'm willing to buy all of this supply, so there doesn't have to be 5 buyers and 5 sellers. And this is where imbalances in trading volume can come in. And this is why I really only like to trade or invest in markets that have real liquidity, right? Like if you're trading penny stocks or altcoins that are super cheap and don't have a lot of trading action, there's a chance that you could be the biggest buyer or the biggest seller in the market, which could actually lead to you getting stuck in a position. For example, if we take a look at this Apple chart, you can see that on the bottom, we have time. Over here, we have price. So as time moves forward, you can see price goes up and down. And for each one of these trading days, so this is a daily chart, you can see as price goes up, there's buyers and sellers on every single transaction. But every time there's an exchange, it's because somebody thinks the price is low and somebody thinks the price is high. That's why there's a meeting of the minds and an agreement between a buyer and seller that causes this movement to go up and down. So what are price charts really? There's a lot of misconceptions when it comes to technical analysis and charting. And so what are price charts? Well, at their fundamental core, price action or a price chart is just the visual representation of the executed trades from all market participants. Basically, what those candlesticks are on the chart is a historical record of all of the executed trades, right? All of the meeting of the minds and the agreement, but where there's a buyer and a seller on every trade. And then at the bottom of the chart, typically you have volume, which is the total amount of units that's traded during that time period. So for example, during this time period, you can see that Apple's stock went from, let's call it $100 around here, up to about $130 over the course of about 2 months, right? And that was driven by the increased demand from buyers, right? Not that there was more buyers, more human bodies or more companies buying, but just that the demand of these shares was higher than the supply. And then you had a shift here where price came down from about $120 and pulled back over the course of several weeks to about $100. And then it continued in its original direction, right? And so markets don't just go straight up or straight down. They typically move in runs and retracements. And then down here, you can see the volume or the total amount of shares that were traded during this time period. Now, the third piece of a price chart is what we call indicators. And indicators are just different ways to quantify price with the goal of using that indicator to help you anticipate what price is going to do in the future. And on any charting platform, you have usually hundreds of different potential indicators, and you can really overload a chart with all this stuff. And most of the time, people just overcomplicate their price charts with way too many indicators. And that leads us to myth number 2, which a lot of people believe that technical analysis or using indicators on price charts is going to tell you what will happen next. But that's really not the case. There's no charting tool, no indicator, no oscillator, no moving average, no fancy trading system with green and red lights and stuff. None of that can predict the future with 100% accuracy. Really, technical analysis is all about finding the path of least resistance, or in other words, the highest probability play, right? Your goal when using these indicators is just to try to have enough information, the minimal amount of information that you can, to quantify price and come up with an expectation of the future. And I'll tell you, in all markets, 90% of market action is noise. Really, the only time you want to participate is when you see something with a technical setup that gives you a high probability of a specific outcome. Now, when it comes to types of market movement, when price goes up and down, there's really like 3 separate categories that I would put this stuff into. The first is what I call regular price action, right? And at any given time, the market is usually doing one of 3 things. It's either trending, right? So you have more demand to the upside, and that creates a trend to the upside, or you have more supply, which causes prices to go down over time. Again, usually not in a straight line, but you have runs, retracements, extensions. And this is where Fibonacci tools can be really helpful. And then you go into periods of consolidation where you hit equilibrium in the price of a market, and price either channels or consolidates and usually squeezes and the volatility goes down. And that's just caused by a balance in price for that time period. It could be a minute, it could be a year. And then reversals, right? You'll have periods of time where maybe you're in an overall bull market or trending to the upside, and then something happens that causes the trend to reverse, right? That's what I call like normal price action. And there's different ways to quantify that. The second is manipulation, right? So if you have a pump and dump scam where you have somebody that either puts out false information about a stock or a cryptocurrency, or tries to organize a pump and dump, which I've talked about those scams in some of my past videos, and why you want to stay away from pump and dump groups and be very aware of anybody's motives behind a news alert, right? Could be even in the mainstream media, right? Or a stock promoter. Manipulation is rampant in all financial markets. And that's why it's just really, really important that you research whatever market you're getting in and understand why you're buying or selling something. And then the third type of market action is what I call a black swan event, which is basically an unexpected event that nobody really could anticipate, right? Something that happened. It could be an earthquake, could be the death of a company's CEO, right? It could be anything that, with the information you have today, you can't anticipate that it's going to happen tomorrow. And those usually cause very abrupt and very volatile, massive moves in the price of a market, right? Or like, say you are trying to buy a stock of a car manufacturer, and then there's a big news piece that breaks tomorrow that says that there's a huge recall that's going to cost them hundreds of millions of dollars, right? That's going to affect the value of that stock. Or say there's a cryptocurrency that launched and everybody's excited about it, and then there's a bug in the code and something happens that causes it to lose massive amounts of value, right? So for the most part, black swan events are unexpected, but if you can find black swan events and anticipate how the market and the mass herd and all of those market participants are going to react to it ahead of time, that's where you can actually position yourself to think like a chess player, which we'll talk about in a second. And let's just take a look at a quick example here. So on the left side, you can see a bull trend, right, where we're trending to the upside, prices growing, making runs and retracements to the upside. And then we go into a period of consolidation where price is basically flat, right? So we've hit equilibrium. So here we have demand that's higher than supply. Then we hit equilibrium. And then right around here, we actually hit a reversal where the overall trend goes from a bull trend or upside where demand is higher than supply to a bear trend where supply is higher than demand. And that's what causes prices to come down. So again, this is what I call overall just regular market action where you have trends, you have consolidation patterns, you have reversals, and then goes back into another trend. So when it comes to using charting tools and technical analysis, there are literally an infinite number of ways that you can use different indicators to develop trading systems or methodologies. And that's been my obsession for well over a decade, is studying different tools, studying and trading different markets and learning how to trade those. And so it doesn't matter what your time frame is, if you're a day trader, swing trader, long-term investor, if you're a counter trend trader, or, it doesn't matter what your philosophy is. I want to give you some questions that you can ask yourself when you're evaluating a market to maybe give you a little bit of clarity on what you expect to happen next in a market. And the first question is, what is the herd mentality right now, right? When you look at a price chart, just forget about the magic indicators and kind of just think about people. Think about people as individual traders, right? We talked about that's one segment of market participants. Think about big institutions, big hedge funds, pensions. Think about even algorithms, right? And just kind of a side note, the benefit to trading with an algorithm is there's no emotion, right? But that doesn't mean that they're foolproof. We've seen that with flash crashes. Like back in 2010, I was in Argentina when the stock market had this flash crash and everybody thought it was the end of the world. So just because algorithms can be fully automated doesn't mean that they're foolproof and always profitable. I spent a lot of time developing that stuff, and that's something that takes work every single day. So again, the big question that you want to ask is, what is the herd mentality right now amongst all market participants? Do people think that this market is just going to moon and keep going up forever, right? Is everybody down and just depressed about a market? Is the market sentiment just really negative? And then ask, how could that change in the near future, right? What evidence do I have that that could change in the near future? And the second question is, who's potentially long or short this market? Not like an individual person, right? But like on a broader basis. So in my last video, I kind of laughed at CNBC where they basically teach people how to buy high and sell low, the opposite of what you're supposed to do. And so what I generally ask is like, okay, if I'm interested in buying a market for, say, a position trade over the next several months or years, I'm asking, is the general public, are mom and pop investors already in this, or do I feel like I'm in this early and this has a potential trend to where it could go up 50 to 100% or more, right? Or on the converse side, did everybody rage quit and is everybody depressed about this asset? It could be a stock, it could be a real estate market or deal, right? It could be a commodity, it could be cryptocurrency, right? I'm always just asking, who's in this? Are the pros in it? Are the hedge funds in it? Are mom and pop investors? Is there going to be a wave of excitement or depression? And then that leads to the third question, which is, how could this market cause people pain, right? Who's in the market and how could this cause people to freak out, right? Because again, emotion is the primary driver behind supply and demand. Doesn't matter if we're talking about Apple stock, Bitcoin, Rolex, or diamonds, right? So something that recently hit in the news is De Beers, the big diamond company, is starting to manufacture fake diamonds, right? So how is that going to impact how is that new supply going to impact the perceived value and future price of diamonds? I'm super bearish on diamonds. I think they're super overpriced. And with this new manipulated type of supply coming out, I think that's just going to crush the price of diamonds in the future, right? So that's just one example. I could talk about this stuff for hours and hours and hours, but I hope these questions are helpful. And I just want to give you kind of a final tip, right? If you're a trader or an investor or even a consumer looking to find good deals on stuff, this mentality is really helpful. Think like a chess player, right? What does that mean? Well, try to look at all the possible scenarios, right? If you're analyzing a stock or a crypto or even the broad stock market, whatever you're looking at, think about all the possible scenarios, all the different moves that the game could take, right? And again, you can't anticipate everything in financial markets. There's so many variables, there's so many market participants, but just think about anytime you look at a market, don't just think one-sided where you're like, I'm bullish on this. I think the price of this is going to go up, and therefore I'm going to have a bias where I only see reasons why this market could go up. Anytime I'm entertaining the idea of an investment or buying a market, I'm thinking actually more of the downside. What if this doesn't work, right? And that's something that new investors and traders really don't like to think about, is the downside or the risk or what could happen if this doesn't work. But finding reasons to buy something or why the trade could work is easy. Putting your ego aside and thinking about why a market might not do what you think it's going to do is even harder. And that's where the real work comes in and where you can actually start to manage risk the right way. So hope that's helpful. And I have just a quick question of the day, which is, what is your favorite tool for anticipating moves in market price? All right, technical analysis tool, fundamental analysis tool, market sentiment analysis tool, right? Could be Twitter, could be a moving average. What tool have you found that works for you that gives you the best reliability of making trade or investment decisions? Thank you so much for sticking with me through this whole lesson. I hope it was valuable. If you have any questions, feel free to leave me a comment below. If you got value from this, give it a thumbs up. Maybe share it with somebody who you think could get value. And don't forget to subscribe to the channel. Plan on putting out a lot more videos like this. So I will see you in the next one. Take care, guys.